Steve Clapham here again, and this is the latest in our investing tips series. In actual fact, the last in our videos on Moats. And before we begin, what I'd just like to do is I'd just like to tell you to please sign up on the channel behindthebalancesheet.com, get our free newsletter, get access to a whole lot of free training materials. And if you're really interested in investing, I also suggest that you sign up and check out our investing courses for private investors. They do cost money, they're not cheap, but they're really well worth it. And I think you'll enjoy them. So I'm going to just switch the video off now, and I'm going to carry on and look at some of the different things in this whole investing tips series on Moats. So this is the 15th video, the 8th on Moats. And what I'm just going to do is review what we've covered to date. So you remember that Warren Buffett coined the term economic moats, and he called it as a structural impediment which obstructs competitors from entering your company's markets and reducing its returns on capital. And the effect is a sustainable high ROIC, or return on invested capital. And I've gone through 7 different moats. 5 of them are real moats: network effects, intellectual property, brands, customer loyalty and captivity, and high switching costs, search costs not being so important in quoted companies. The other 2, economies of scale, only become a moat at very, very large scale. And there's relatively few companies that enjoy a moat because of economies of scale. And the last one, sustainability and purpose, I covered. But really, this is much less of a moat today than it was in times past. And it's more of a license to operate, I think, today. So what we've got here when you're assessing quality are basically 2 components. You've got a qualitative component and you've got a quantitative component. And when you're looking at qualitative, I've discussed some of these traditional moats, but what I haven't covered are economic advantage assets, as so coined by a very smart UK fund management firm, and my proprietary moats, which tend to be in the digital area. And I've saved those for the courses. And there's some other aspects which I may return to as we talk more about quality in this investing tip series. And similarly, the quantitative aspect, looking at returns, there are lots of different facets of this, and we'll perhaps cover more of those in later videos. But in conclusion, quality has been really important in the last decade, and in fact, in the last 50 years. Right now, it's probably less important than it would normally be because we're not in a quality market. What you get is quality tends to outperform in the downturn. And as you go into an economic recovery, quality lags, because the things that go up the most are the rubbish, the really low quality stocks. Another issue about quality is it's very highly rated today. If you look at the Fundsmith portfolio, it's seen a significant re-rating. The free cash flow yield in that portfolio is down probably 60% in the last 10 years. Not the same stocks as there were 10 years ago, but it's indicative of what's happened. So that's the end of the Moats series. Hope you've enjoyed it. Don't forget, subscribe to the channel and sign up for the newsletter on behindthebalancesheet.com. Thanks for watching.